So, hey everyone, in this video we'll be talking about the Monte Carlo simulation, one of the most important topic in the finance and the quant world. So before starting, I would like to tell you about what is this simulation. So basically, it is the method used to model and analyze complex systems and process with uncertainty and randomness. Since we know that the stock market is a market which is full of randomness. You cannot predict the future. So here, Monte Carlo simulation help us to, uh, gives us, the results of uh, different approaches that we can actually get in our journey of the stock or the share price. So basically, it is the model which is used by the probability of complex events by compiling thousands and millions of various outcomes to predetermine or to have a forecasting in general in the stock market. So if I talk about what are the steps related to it, so the simulation works with the step one being the problem modeling, the second being the random sampling, and third simulation, and the fourth being the statistical analysis. So I would just go down to each and every step, and then we would go to the code and we would try to understand what basically and how we could actually use this into the finance journey or into our strategy if we are, trading or something. So the step one is problem modeling, as we discussed. So you start with a real world problem. For example, if I talk about need to know what will be the share price of S&P 500 after a week. So I, in that case, there is there's an uncertainty and randomness. I have no clue. So this could be, anything from the financial investments to engineering designs, projects, or scheduling, or even assessment that we would actually try to, compile into it. So the second step is the random sampling. So instead of try to solve the problem or to get a precise result, we try to use the random sampling method to generate a large number of possible scenarios that what could be the probability distribution that the S&P 500 after a week may reach, more than, may jump higher or may fall down after a 1 week. So these distribution help us to, predict the future and to tell us the range of uncertainty in this system. The step three is simulation. For each set of random inputs, you apply rules, equation, and algorithms to govern the system. And this allows you to actually calculate the output or the result in an efficient way. And in a way, you are predicting, but you can have a higher prediction or a higher level of accuracy into the simulation and to create and it helps you to create a broad range of simulated outcomes. The step four comes to the statistical analysis. With the data set of simulated results, you perform the statistical analysis to gain insights into the behavior of the system. This may include understanding the distribution of possible outcomes, calculating the probabilities, and identifying the potential risk or the opportunity in general. So, yeah, so Monte Carlo is basically, you try to create situations where there is, there is complexity or randomness, and you try to predict that randomness to, forecast what would be the future, what would be the future. So, if I talk about the code now, so basically the code is simple. So step one is to like import the, the required libraries that we need. So here we have imported Finance, Pandas, NumPy, and Plot, for the graph uh, plotting and similar to that. So in this, the main is the import of NumPy because this is used for data manipulation and for, the forecasting of or to get the, different results. So therefore, import of NumPy is very important. So after that, we'll try to download the historical data. I have used the ticker symbol of the SPY, which is an index fund in the US, and the start date is 2015. 1st Jan to 2015 31st um, May. So after that, we'll download the ticker symbol with the start date and end equals to the end date and multi-level of index, which equals to false, close, and this is how we actually try to get the historical data. Here you could see the kind of a little bit example of it. So here you could see on 2015, 2nd Jan, it is like $171.56. And this goes like from 5th January, it has reached to 168.46. So this gives you all the historical data till 2015 to the, the 31st January, February, March, April, May, till May. So 2025, 1st Jan to 220, 2025, 31st June. So you get the 10 years of data in general. So after that, we will try to backtest our strategy. So basically, for the strategy, we will be using the MA10 and the MA30, which is the moving averages 10 and the moving averages 30, and we will go long to it. We won't, try to predict the market in the short terms, and we try to stay out of it. So over here, you could see I have actually created one, MA10 and the MA30. So here on the SPY index, over here, you could, how we actually do this. So for example, when the price or the candlestick is above both the two lines, we would buy the stock. And when any of the when the candlestick will fell or will be below with any of the line, we'll sell it. So here you could see, we buy here and we sell over here since it has reached, below both the lines. And once we go long here, we buy here again. But when we came to below both the lines, we'll, sell it, and this goes on and on. Over here, you could see as well uh, that over here, we would buy the stock, and since it is, above the MA10 and the MA30 line, and once it, reached here, we would sell it. So this is a strategy that could be used, buyers. And in first go, you'll think, oh, this is a, if you have predicted the market, we have found a loophole, or you could become a billionaire out of it. But this is not the case in general, because there is, the risk, abided to it, and it could lead to some complications, or may lead to, some disruption in the portfolio, since it's a strategy. It won't work every single time. uh, and the reason is simple. You are, you are predicting, you are in a market where, randomness changes every single time. So you can't, predict the future every single time. And if I go to the backtesting again over here, we are able to see that we got the closing price of each and every set of the data price with the MA10 and the MA30, with the returns as well on this. For example, over here, the return was 0.4%. And on, if you see this side, 19 February 2015, over here, there was a negative return as well. And after this, we'll try to visualize the strategy return on a graph, and we'll try to, you know, plot the performance using, Plotly for, interactive visualization, and to, for better understanding. So over here, we'll take our initial capital as $1,000, and we would have a function where the initial capital will multiply to the 1 plus the strategy returns. And if I do this, would be correct. Okay. Over here, once we have done this, we would try to add create subplots with two rows, and we would add the drawdowns. Basically, drawdown is the maximum, you know, down returns a stock price or a company could give you in a year. So, for example, when I, you know, start this over here, if I talk about the drawdown, so the highest drawdown over here is 12%. We could say it's 12%, or 11 minus 11%, only 12% is the, the highest drawdown or the highest level of fall this stock can give you. And if we talk about the returns, we could see, if this is a period of 9 years or 10 years over here, when we started from $1,000, it has reached, something about 2000. It has doubled the price in 10 years. So for once you would, try to see, okay, we have found a loophole and we'll try to, exploit this strategy. We can make be a billionaire out of it. But after, after seeing these graphs, yes, you could actually say that this is something that you could actually use into your, trading strategy, and you can make a lot of money out of it. It's like a printing machine. But in reality, it is not the case. So before starting further with the Monte Carlo, and would try to, tell you about how, all this works, I would like to tell you what is basically Monte Carlo, why we are using it. So Monte Carlo, I actually told this again and again. So Monte Carlo, we are using it to, predict the future. And for this, we try to, tell us an idea about the different, you know, uh, in outputs you could get, uh, if we, we try to predict the market. So for example, this is the glass of water. This is made up of glass. Okay, if I throw this, so it may, if I have to check the robustness of this, how strong is this? So for that, if I could throw this on the wall, it would fall. So for that, there would be a less strategy or a less inputs I have to give to, get the output. For this, I could just throw it into the wall on the floor and I would get the result. Okay, it will shatter. But if it was a plastic bottle, if it was a steel bottle, in that case, there could be, any many examples. For example, if it was a steel bottle, it can resist steel, cold and heat as well. So in that condition, there could be, many, strategy, or many times I have to, see the robustness, to check the robustness of the bottle. So here also it's the case. We try to, check the robustness or the, the future of the price by different inputs, by giving different inputs or strategy to get the output. So over here, if you try to see the cumulative return, so over here we could see that the total return, if I get the this again. So during this period of 9 years, we got a return of 96.5%, which is like you double up the money with an annualized return of decent. It's 6.95% with the annual volatility over here is 8.6. I won't say it's that volatile, but it's not that good, And same is for the Sharpe ratio. It is 0.8. Not worse, but not as good as we expected. A Sharpe ratio higher than 1 is, something that we consider really good in the finance world. And the maximum drawdown is minus 11.69% to be precise. So in the step 4, we would, we try to convert the strategy logic into a function. So how are you going to do this? So firstly, we like to enable the reuse across the multiple price series, and we try to speculate the backtest logic in a function. So over here, when you saw the graph, you would think, this is a strategy that we could actually use into our trading input. So one thing we have to learn is that over here, if we see the graph, there is a lot of dips and lot of highs. So for in this case, the Sharpe ratio won't be that good. So in this case, in this function, we try to accept a price into a starting capital, applies moving averages across the strategy. And then, we try to finalize the, the portfolio over the period of time. So how we're going to do this is we try to backtest this strategy. And after it is done, we have used MA10 and MA13. We try to signal it if, our signal is greater than MA10, we would pull back. And if our signal is, greater than MA30, we would be there in the strategy. And in the step 5, we try to simulate the alternative pricing paths using Monte Carlo. And this is something that we will gonna discuss, which is the important part. So to explore this, what we'll actually explore in this is how path dependent is our strategy is. Like how much reliability we can have on the Monte Carlo, and how dependent we could be, because there are some times in the financial world where the path or the charts cannot be predicted. So this is the case. We try to, but in some companies or some shares, we try could predict the price, and this is a part dependent. So when we gave the 9 years or the 10 years of historical data, it has, has all the part dependent of back at that time, and also it can, try to push that historical data or the path which were in the past in the future as well. So we will use log normal model for this and try to, based on this, and try to make the historical return distribution of SPY to generate the multiple price paths. So the each path starts with the same initial place price, but it follows a different sequence each and every time. Because in this file we will use about 5,000, which is a really high number. So we're going to use that to for better, understanding. And I would like to, show you this. Over here, you can see the 5,000 uh, we got. So if I change this, for example, if I set my number of paths be 100, for example. So over here, we would get 100 of these. So you can see the array of $174.72, which is for the SPY, and it tells, one go for 174, one went 233, one went 938, like that. On one went, 1,520 point dollars and 15 cents, like that. So right now, I would love to do this 5,000. So when we do this, 5,000 as a number of pi, it will give us a denser graph or a denser figure. So I will also show you that what we are actually talking about. So when we got the figure, so over here you could see that this we started from 198, so to say, and you could see different paths over here. So one path can lead to about $2,520, and one can also lead us to a negative return of 187, which is lower than the initial price we started from. So this gives us a an overview about what could be the price or the prediction of the share price in the future. And and this is how we try to predict it. And so in generally, you may think that what we are actually doing is just putting up these beautiful lines over here. It looks so beautiful and colorful. So what is the sense of this? So in this case, we are trying to predict the future. We try to get a path dependency. That is it possible that this share price it has a path dependent or not, or can a strategy is good, or it has, since we as people we have you know given a lot of depth to this model. We have given a lot of thinking to it. We have a lot of confidence. We are backtesting our strategy. So in this case, we try to understand it, what it really means. And when we apply this strategy to a stimulated path, we know that each of 5,000 Monte Carlo stimulated price path can be applied to our trading strategy. And it- and for this you can use the same logic as before. So this gives us a distribution of possible portfolio outcomes, allowing us to access the path dependency of the strategy. If the results vary widely, the strategy is highly path dependent. Remember this. And if there's a constant, there's a consistency, that means the strategy is really robust. That means it is on the right track. Your strategy is great, you know in this case. So when we try to pull this, so the strategy list, and over here we try to get the how much we try to backtest our strategy, and when we go to the next step, which is visualizing the outcomes across simulations. So in this also we'll be plotting a graph of 5,000 portfolio values under the same strategy. So the original backtest strategy, which was this one, we over here, this will be also be included in this strategy as well. So when I click on this, you will get the link over here. We could see that now there are also different strategies again. And over here, this black line shows us the original backtest strategy that we gave or we actually had. So in this, we could see that this could be, is it is giving us about 258, and over here it is reaching more than expected, and it is also giving us a negative return as well. So from this we are trying to convey that number, that how long the day goes. We are trying to predict the market, and we are trying to you know try to forecast the share prices of the company. When we go to the distribution of the final portfolio value, let us now look at the distribution of final returns from all the simulation to get a probabilistic sense of strategy performance. So here our capital is about $1,000 again, but this time we'll try to make a graph in which we'll try to break this down into five categories. One is the fifth percentile, 25th, 50th, 75, and the 95 percentiles to try to get to know about the total returns and the final values that we got. So when we click on this, we get this. So over here, we could actually try to convey that this yeah, okay. So over here, if I go over this side, which is I think the negative side, so the probability to get uh so I in this in this graph, we could say that the probability for me getting a 251 return or more than that is 5% only, because the 95% of the time it is on this side, on the 150 to the 250 side. And this is we are trying to convey. And what about the fifth percentile? It is it is showing us about minus 13 313%. So this case that the so we can have a confidence as well. So the strategy to we try to now we are able to break down it, so that as a person, when I look at this or look at my strategy, I could say that the probability of my strategy to go below minus 13 to minus 13% is only 5%. It is less than 10%, so to say. And the same way, the strategy that goes above than 251 return is 5% again. And where is the majority of the uh the uh, you know the predictions that we could actually take, it's between the 75th percentile and the 50th. So over here, getting we are 50-50 to get a 72% more or 73% more in the trade. And we are 75% confidence that we can get 129% plus. So in this we'll try to give you an overview about how much the total return or the frequency could be to get the total returns. And this is it. And over here, I also included the graph. So the fifth percentile, which is the minus 10.48, this is the worst. Same with the 95 one. This is the top 5%. The 75th, the 25 simulation exceeding, which is a strong right tail. And most of it, if we see, lies between the 50th and the 75th percentile. So here we could say that in general, if the stock goes ahead in the future, it will most likely to fall under these two categories. Or it may get lucky, it may go to this, it may you are unlucky, it may also go to this strategy. That's it. So when we are, the step 7 is to evaluate the risk and the return quality across the simulation. So we won't go beyond, we would like to now go beyond the total returns and like to commute two key metrics in this 5,000 simulated. It first is the maximum drawdown or the worst peak or the worst drop down that we could actually can get in the share, and the Sharpe ratio, which is the return per unit of volatility, a measure for a risk adjusted performance. Talked again, the a really good Sharpe ratio is more than one. Below than one, it really depends. But if it is 0.8 plus or 0.8, it is generally good, not best. But below than that, it can raise serious questions. So once we actually, oh, I would like to explain this as well. So first we'd like to calculate the max drawdown. So over here, we are running the max equals to the maximum accumulate series, and we try to do this by, minus subtracting the series with the maximum running maximum divided by the running maximum. And for the calculation of Sharpe ratio, we'll be doing it with the annualized or the annual volatility equals to the standardized return multiplied by the 252, which is the number of days of trading in a year, the whole square of it. And after we, try to do this, we would get our result. And here it is, the maximum drawdowns that we could. Now over here, it's, something that we get saddened since the chances for the drawdown is a lot higher than we actually expected. So over here we could see that it can also go, so the minimum can go to about 11%, but the maximum could reach to about 21% or 25%, and this can go on and on. Over here if we try to see that this place, the minimum is here, but we have a higher chances to also go to this side. So what we have learned that the strategy can only give you a path dependent result. It can show you the robustness or how strong your strategy, how strong the company or the share price is. It is not a money printing machine that you could use blindly into your trading strategy and would expect 2x or 3x returns. This won't be the case. And once we go to the backtest and we try to backtest the Sharpe ratio as well, we get this. So over here, the minimum Sharpe ratio for us is about 1.8, 0.8, sorry. And over here, we could see the highest frequency is about uh, you know 0.36, which is a really bad Sharpe ratio. So from this, we are able to conclude that uh, the maximum, the tight max drawdown distribution with a shallow value implies the strategy really suffers severe losses, and a Sharpe ratio consistently above 1 across simulation means the strategy not only performs well, but it is also has a really strong adjusted risk consistency. So together from these distribution, it actually gives us a very well-rounded picture of how strategy performs, not just on average, but across different simulated realities, balancing upsides and downsides and volatility. So, in conclusion, we could say that Monte Carlo simulation gives you is a very path dependent, and it tells you what could be the future and how robust the strategy is. Other than this, you could use it, but it should be used carefully as it can have its severe effects. By this, I would like to end my video. Thank you.